Imagine a daily life where this beach isn't just a vacation destination but your backyard. That's the allure of financial independence. And if you're dreaming of this scene to be your own reality, then let me tell you that there are three things you should remember when building your wealth: real estate, businesses, and the stock market. Today, let's delve into how these three can pave the way towards your financial freedom. This is Foxfire Finance, and we are committed to spreading the great news and concepts of the FIRE movement to anyone dreaming of a better life. We aim to help you achieve your goals by providing meaningful tips and strategies that will bring you closer to your dreams of financial independence and retiring early. But first, don't forget to subscribe, burn that like button, and ring the notification bell to be updated on our latest releases to guide you on your way to FIRE. Kicking off with investing. The idea is simple. Instead of letting your money sit idle, why not let it work for you? Every dollar you possess can be seen as a dormant seed holding potential energy. When these funds remain inactive, simply resting in a regular savings account or under your mattress, they miss out on opportunities to flourish. Investing is about channeling that money into ventures or assets where it can grow, multiply, and bring returns. It's about being proactive with your financial resources, turning passive savings into active assets. So instead of watching your capital collect metaphorical dust, why not empower it to thrive and fortify your financial future? Here are some useful tips to keep in mind when it comes to investing in the stock market. Tip 1. Begin early, even with modest amounts. Starting your investment journey early is invaluable, even if it means beginning with just a small sum. The sooner you initiate, the more time your money has to compound and grow, leveraging the power of time in the market. Small, consistent contributions can amass significant wealth over the years due to the magic of compound interest. Essentially, early investments, however humble they may be, set the foundation for a robust financial future, demonstrating that it's not always about how much you invest, but rather how soon you begin. Tip 2. Spread your investments. Don't bank on just one. Diversifying your investments is a fundamental principle of sound financial strategy. By allocating funds across a variety of assets or sectors, you lessen the risk associated with market instability. Think of it as not putting all your eggs in one basket. If one investment underperforms or faces a downturn, others in different areas might thrive, thereby balancing out potential losses. This approach ensures that you're not overly reliant on the success of a single venture, which can be vulnerable to unforeseen market shifts or external factors. In essence, spreading your investment acts as a safety net, optimizing potential gains while cushioning against the unpredictable nature of financial markets. Tip 3. Remember, it's a marathon, not a sprint. When it comes to investing, it's crucial to understand that achieving significant returns or reaching your financial goals isn't about quick wins or short-term gains. Instead, think of it as a marathon. In a marathon, the focus is on endurance, strategy, and long-term vision, rather than instant fulfillment. Similarly, with investments, patience and consistent deduction often yield the best results. Market fluctuations are inevitable, but over time, they generally trend upwards. Rushing for immediate profits or panicking with short-term market dips can lead to impulsive decisions. By maintaining a long-term perspective, you allow your investments to mature and compound, harnessing the full potential of sustained growth over the years. So let's move on to number 2, investing in real estate. Shifting our gaze to the tangible world of real estate, it's more than just buying a place to live. It's about leveraging property to generate income. The dual power of rental income and property appreciation can act as twin engines, propelling you towards financial freedom. Here are some useful tips to keep in mind when it comes to investing in real estate. Tip 1. The golden rule: location. Location is a key factor in real estate investing due to its direct influence on property value and potential returns. Prime locations ensure higher demand, driving up rental and sale prices. Proximity to amenities, transportation hubs, and employment centers attracts more tenants and buyers. Moreover, areas with strong economic growth or upcoming infrastructure projects promise future appreciation. Essentially, a strategic location not only guarantees immediate desirability but also secures long-term investment growth. Tip 2. Stay informed about local market trends. Keeping yourself updated about local market trends is essential for anyone investing in real estate. Local trends such as shifts in supply and demand, emerging neighborhoods, or changes in employment rates directly influence property values and rental yields. Being knowledgeable allows investors to anticipate market movements, enabling timely buying or selling decisions. Additionally, understanding local nuances such as seasonal rental fluctuations or regulatory changes ensures that investors can adapt strategies for optimal returns. Essentially, staying up to date of local trends gives ways in capitalizing on opportunities and navigating challenges, ensuring the resilience and growth of your real estate portfolio. Tip 3. And finally, look for properties with potential, not just polish. Sometimes, value is more than meets the eye. Going for properties with potential over mere aesthetics is a strategic move in real estate investing. Such properties, often undervalued due to cosmetic flaws or needed repairs, offer investors an opportunity for significant appreciation post-renovation. This potential translates to higher margins of profit upon resale or more attractive rental yields. Moreover, they often provide better negotiation leverage during the purchase, resulting in a lower entry price. By focusing on underlying value rather than surface aesthetics, investors can harness the dual benefits of immediate cost savings and long-term financial growth, making the investment journey more rewarding. Number 3. Investing in businesses. And then, the realm of dreams and innovation, business. Establishing a business is crafting a machine. Once built and fine-tuned, it can keep generating revenue. Investing in businesses embodies the spirit of passive income. You set the wheels in motion, and then, even in your absence, the machine runs. We have these tips to guide you as you invest in businesses. Tip 1. Passion is your starting point. Investing in a business tied to your passion offers more than just financial returns. It links personal fulfillment with professional accomplishments. Passion drives resilience, guaranteeing constant motivation even during challenges, and naturally brings up an in-depth understanding of the industry. This inherent interest increases authenticity, creating genuine connections with clients and customers. Moreover, working on what you love blurs work-play boundaries, leading to enhanced productivity. Beyond monetary gains, a passion-driven venture nourishes the soul, offering deep satisfaction. Essentially, aligning passion with business amplifies chances of success and renders a uniquely gratifying entrepreneurial journey. Tip 2. Know your audience like a close friend. Knowing your audience intimately when investing in business is essential for customized offerings and sustained success. Just as a close friend's preferences, needs, and pain points are known to you, understanding your target demographic enables precise product or service alignment. This deep knowledge helps in anticipating market shifts, which in turn ensures business adaptability. It builds up authentic engagements, growing brand loyalty and trust. By connecting strongly with their desires and concerns, businesses can create compelling value proposals, enhancing conversion rates. In essence, a profound understanding of one's audience isn't just a strategy, it's the bedrock of customer-centric growth and lasting market relevance. Tip 3. Growth requires investment. Don't pull out all the profits. Investing in business is a long-term effort, where the boosting of potential often requires consistent reinvestment. Pulling out all profits can be tempting but could stop growth opportunities. Reinvestment channels funds back into the business, facilitating expansion, innovation, and adaptation in dynamic markets. Furthermore, reinvestment can fortify a company's financial position, allowing it to weather economic downturns more strongly. In essence, while instant profit realization offers short-term gains, reinvestment paves the way for exponential growth, long-term stability, and sustained profitability. Financial independence isn't about massive wealth. It's about freedom, choice, and living on your terms. Investing in the stock market, real estate, and businesses are pathways to this dream. Why wait? Embark on your journey today. Did you find this video helpful? If this guide lit the spark for your wealth journey, then burn that like button. And don't forget to subscribe to our channel for more tips on how you can reach your financial goals. Until next time, we are Foxfire Finance, and keep that fire burning.